The Fed just made its first interest rate cut in over a year, but why now, and what comes next? The Federal Reserve cut its target rate by 25 basis points, bringing it down to between 4 and 4.25%. This marks the first rate cut since December 2024, ending months of speculation about the Fed's next move. The decision comes despite political pressure for deeper cuts, showing the Fed's independence in monetary policy. Surprisingly, the Fed projects 2 more 25-point cuts this year, but there's significant disagreement among members. Fed Chair Powell admitted there are no risk-free paths as the central bank faces conflicting economic signals. The labor market has cooled dramatically, with job growth nearly stalling in recent months. Meanwhile, inflation has accelerated due to tariffs pushing up import prices, creating a policy dilemma. The Fed's dual mandate of price stability and maximum employment are now in direct tension. Powell explained the Fed must balance these competing priorities when they conflict like this. The committee ultimately decided unemployment risks outweigh inflation concerns for now. This shift in risk assessment led to the decision to begin easing monetary policy. The path forward remains uncertain, with no clear consensus among Fed members about future moves. These rate cuts could mean lower borrowing costs for mortgages, car loans, and credit cards. However, savers may see lower returns on savings accounts and CDs as rates decline. The Fed's actions will continue to impact everything from stock markets to business investment decisions. Looking ahead, the Fed's next moves will depend on whether employment stabilizes or inflation worsens. This delicate balancing act shows how complex monetary policy becomes during economic transitions. Now, the Fed's decision reflects their assessment that supporting jobs is currently more urgent than fighting inflation. The Fed's rate cut signals a shift in priorities, but with economic uncertainty ahead, consumers and investors should stay informed.